Hey, good evening, guys. Ken at Tortoise Capital Nightly Strategy Podcast for Sunday, October 24th, 2021. So I was searching for some things and found something else. And this little nightly podcast from earlier this year on VUCA and systems development was pretty interesting. I just noticed I had Ken H had sent me a link to a graduate certificate program from Cornell University that was crafted by a former chief of staff of the Army, General Casey. And so he wrote a certificate program that Cornell University is selling, teaching on being an adaptive leader. And it features lessons on dealing with VUCA, volatility, uncertainty, complexity, and ambiguity. And I noticed that the irony of that is that when Casey was the chief of staff of the Army, we were trying to get that kind of curriculum into our CGSC curriculum and had pushback from Department of the Army, who wanted us to emphasize more of the basics of blocking and tackling and doctrine. And so now that he's retired, he's authored this course that Cornell University, it's 5 2-week courses, and it's $4,000 to take the course to learn essentially what I teach you guys about VUCA and management in these podcasts. And so the irony is delicious. That same podcast was pretty good. I ended up talking a little bit about, once again, the difference between execution R and position sizing R, and how in hybrid trading we use the idea of the minimum manageable risk box in order to reduce the amount of adverse price action that it takes to disprove the hypothesis. And that if we could end up in a little doji like this and then make different entries at either a mechanical entry, 5 cents above the doji, or a 1, 2, 3 entry, or an RLXD entry, or an OWL entry, and finally a frog box entry, that any one of those could be a reason to get in, and there's all criteria for those. And the same price down here at a violation of the low of the doji is the price that invalidates all of those entries. All of those entries represent a bet on the hypothesis that this thing is going to go 2 frog boxes above your entry, up to a range stat, which is the maximum reasonable intraday move. Well, the idea here is that if your doji entry, the mechanical entry, represented a 0.1 of a frog box, you wouldn't want to have 10 times the position size compared to what you would have if you used a full frog box entry. If you just use the size of the stop and divide that into your dollars at risk to compute a maximum entry, then you might find yourself doing that, which in my view would be a mistake. My belief is that no matter which one of those entries you use, you should pick a standard position size based off the frog box entry. And then if you do take this entry and it fails, you really only take a 0.1 R loss compared against the position sizing loss of the frog box. But if you take a 1, 2, 3 entry and it happens to test out at 0.2 and then it fails, you get a 0.2 loss when compared against the position sizing risk that you take off the frog box entry, which is why when we talk about the execution R, we're talking about the price that disproves the trade's hypothesis in the immediate context of the particular trade frame. It's defined by the pattern that you're in and where you draw the failure of the hypothesis line, in this case below the doji. Whereas the position sizing R, in my view, is defined by the style or the time frame of what you're trading. So when I'm day trading, I always use the frog box as the baseline for my position sizing. It's just easier that way. And for swing trading, I use 2 ATRs as the basis. And for core trading, I use 10%. And I've always used those for the last 10 years. And that way, I have a very consistent approach that has endured for a decade for me. And it gives me no angst whatsoever to operate with those numbers because I have 10 years of experience with those specific parameters for defining the size of the position sizing for the type and style of trading that I'm doing. And then I can refine the particular trade frame based on all of the context that goes into the tactical trade frame in that moment and decide where I want to get in and what price is going to pay me to get out. And then those are just fractional gains as part of the larger position sizing box. And that just stabilizes my life tremendously and puts all my energy into executing the pattern correctly and not worrying about the math of the, hey, how much is my position size going to be this time? And is it crazy large compared to what it otherwise was? I don't have time to be messing around with that much variation in my position size. It would drive me nuts. So that turned out to be a pretty good video back in those days. That's part of the lessons for the hybrid trading. One of the other charts I was coming across, this had to do with some folks were talking about the skill progression. And this was from last year, 2020, June 18th, where we were talking about kata. We're starting to make a big deal of kata in June of 2020. So at that point, we were about 3 or 4 months into the COVID, and we were doing, the nightly strategy podcasts and teaching the advanced hybrid trading course. And this is where we really refined the ideas of kata explicitly and defined these variations off of the owl and the collapsing dragon. We added the supported spring crossing as a way to accelerate our or front run the owl and to front run the collapsing dragon. And then we added to it the supported fall crossing, supported winter crossing. And then we had this series of trades that we take when you don't have a strong directional move ahead of time, that you have what starts off as a sideways quiet channel, and then which compresses into the abnormally sideways quiet channel of a Z3P, which is even more abnormal when all 4 regression lines come in and you have a super pinch. So the further to the right on that scale you go, the more you like the breakout because it is abnormally compressed. And so this was the logic trail that we said that if you wanted to master these patterns from hybrid trading, you should start clearly with the supported spring crossing, because that one can lead you to a supported fall crossing, which is a kata 2, or the failure of that can be a supported winter crossing. And if it goes far enough, can collapse into a collapsing dragon. But you might also, if that trade's working, lead you to the owl or the emerging dragon. So that became the sequence in which we recommended that you master the patterns using the principles of kata. And this was based on our hard-won experience using the walking man and the 5 ways of knowing: head, heart, gut, hands, and feet, and the use of our nightly podcast and our collaborative learning circles called the True Story Circles, in which we create a safe space with people that you can trust, where you can tell the truth about trading and opportunities for development will occur. As part of that, there was the, somebody asked me earlier for the flashcard for the supported spring crossing. And this, I think, is the best representation of it. I've drawn it many, many times with pencils and black and white, but this one to me is the best representation of that, where you have the harsh winter defined by the RL10, and the MACD histogram has turned that red, and that you get the bottoming out of the dragon, or of the RL10, then it crosses the baby dragon as an alert. The winter turns to spring, it enters the dragon, it crosses the dragon, and the sight picture, this is from rifle marksmanship, what we talk about is what is the sight picture you want just before you pull the trigger, and the sight picture that you want that justifies the pulling of the trigger is this one, where you had the harsh winter, the crossing of the baby dragon and the dragon, that winter has turned to spring, that the PSAR has flipped, and so you buy in here before it crosses the PSAR, and then off you go, and then you use the risk box of the entry down to the PSAR flip, and then you set that equal to 0.2 position sizing risk, so that if it fails and it gets you into the collapsing dragon, all you lost was a 0.2. And then we use the bottom of the dragon, or that PSAR bottom flip right here, as the collapsing dragon entry. And then the first decision that you make is to get to no lose plus dinner for 2, at which case you are absolutely in the zero state, because you have $0 at risk. And the worst thing that happens is that you're going to make money. And that typically you're going to be aiming for some reasonable target above, which is like intraday, a range stat, or a return to the VWAP, or a return to the RL270, or some other reasonable price resistance level. And that's somewhere around 3 execution R's in hand, which is a 0.6 position sizing win. Somewhere around in here, you got to think about activating the sniper, because you're going to have an above average win, and you want to keep more of the above average win. And then somewhere above 3 execution R in hand, you should be certainly thinking about when do I, or how do I split my exit between the sniper and the manager, and where am I going to add second position? So those are the 3 decisions that we see, that as you're managing the exit and managing the position, those are the 3 decisions that you got to master. And how you get from your initial risk up to no lose plus dinner for 2, I covered extensively yesterday. So I just wanted to share with you that sight picture. And then from the foundations course, we pulled up these old, the idea of pinch and stretch, and the idea of the pinch box, and the nature of why super pinches are so powerful, that you have a compression of price, and you have all 4 of the regression lines, the 10, 30, 90, and 270, all within a tight box, whether that's a frog box intraday or an ATR or 2 on the swing trade, that you have an observable, tightly compressed set of all 4 regression lines, and that you're ready to play the breakout in either direction, and that those breakouts occur and then create intermediate short-term pinches with the 10 and the 30, while the 90 and the 270 are slower to react to that initial sell-off, and that maybe you get a pinch, like a Z3 pinch down here, and then maybe there's a fake 1 go 2, and now you're playing as a return from this maximum excursion back to that RL270, and that's what the RLFF framework looks like. And then from here, you may end up getting your next super pinch when all 4 of those regression lines have come back into the station, and you have a sideways quiet channel that is abnormally pinched. These little intermediate pinches now can become a super pinch, in which case you might get a second leg up that takes you right back to the original super pinch altogether. So I think of these as a series of breathing expansion and contractions as we watch the price being described by the different lengths of regression lines. Becomes a very fluid, hydraulic way to understand what's going on in price action and to characterize market psychology in terms of that interpretation. So just a quick shout out to the hybrid trading course. Some of the other stuff that we had done in the hybrid trading course was working on psychology things like the walking man and the roundabout as ways to generate zero states and creativity. We worked on some ways of managing beliefs about trading. On the left-hand side is when trading acts as an energy drain. On the right-hand side, where we want it to be an energy pump such that trading invigorates me. And then the bottom half of this chart is where we map the beliefs that the belief that the energy drain of trading is a reality. That's just based on a set of beliefs that we would put into this square. And then the idea that the trading could be an energy pump that invigorates me is supported by a set of beliefs over here. And that you can envision that, but what we really want to then develop are the transition frame beliefs that allow you to move from the first set of beliefs to the second set of beliefs. What are these transitional beliefs that, number one, can help me push myself out of those beliefs towards those, and which ones will pull me through that transition? So in the intermediate term, we're looking for all those powerful forces for good that are helping me leave behind the unproductive beliefs and adopt the productive beliefs. And the transition beliefs are the ones that allow me to believe that this transition can occur. Because a lot of folks will say, well, here I am, and that's where I want to be, but how do I take that first step? So it turns out that filling in this gap of transitional beliefs is absolutely the most important thing that you can do. And so we went through some exercises where we mapped out what it looked like and felt like to have trading as an energy drain, painful. And then pictures of what trading as an energy pump would look like that followed the natural cycle of water and the flow of seasons in MACD, and that my job is just to get paid. I don't have to be other than just going to work every day, making hay slowly, be like water, that there's an infinite number of trades and the sun will come up tomorrow. And if I just align myself with natural forces and follow the hydrology, that I'm going to be fine. And then I can leave behind all of these unproductive beliefs like everybody is against me and that the world is filled of tigers and crocodiles, and I'm trying to work my way up an uneven slope, and that everything is against me and it's stress and time working against me. All of those beliefs interfere with being able to adopt the beliefs over here, where all under the water cycle approach, I believe in natural flow and that things happen and that according to plans, and that rivers flow, and that the power of water allows me to simply float and gently steer and let the water carry me along, and that I can sense and respond without drowning, and I can free myself to do that without having to take ownership and responsibility of every single thing that happens as if I have to be perfect. Well, what allows me to go from belief set 1 to belief set 2? I have to believe that I can relax and learn to relax, and that I can study ecosystems and water flow as natural forces and know things about the river and know things about trading and my role in it. And I can respect the flow, and I can learn that I just have to do my own part, and that enough is enough, that I don't have to be perfect. These act as powerful forces that help us leave behind these unproductive beliefs and adopt the productive beliefs that allow us to trade in a holistic hydraulic style of manner. And that's reinforced by a lot of things that we know from the world about why persistence matters, and how the principles of jiu-jitsu and natural animal movements and drumming, and the idea of diesel engines at work and mules wanting to pull and huskies want to run, that there is some natural forces inside us that just we want to do work as part of our nature, and that if we tap into that and accept that and find that we can apply that, and that helps us with the motive energy and the motive power to do this work that takes us from belief set 1 to belief set 2. So there was some good work that we are doing in the psychology of trading in the hybrid, and that was was glad to be reminded of those things. The final one I want to talk about, and I'll share this piece later, is this one that talks about the flashcard for the hybrid trading. And at the start of that, we had summarized 5 particular patterns, and then the foundational beliefs up in here that summarize all of the principles of hybrid trading, and that the time periods in which we operate on, and then the specific patterns. There's 7 there of the 5 patterns. There's 7 of them there, and some of the supported spring crossing is really a subset of the owl, and that was, so we developed that one in more detail even after we did this. But we talked about the what kind of a technique it was, what kind of concept and direction did it have, and what was the basis of its move, and how do we treat different aspects of it? What kind of markets do they work in? What are the entries, the initial stops, the targets, the reward to risk? What kind of trade management principles did we use, and all of that jazz? So a lot of good work embedded deeply in the hybrid trading course for those that are interested in that. All right, let me jump back into tonight's work. What are we looking at here? Let me just start with a couple trade frames from Bob, if I can find those. I thought I had those open already. I guess not. Yeah. Here's one Bob offered on U.S. Steel. And what he's got going on here, I'll just have you note, he uses a variation. He uses a MACD 430 instead of 1030, and he still uses the 5. And he puts a little 8 and a 1.6 Bollinger Band on here, he likes that picture of that little ribbon. Looks like a little ribbon going through time, which I think is cute. And so what he likes is this one where you have that, you have the summer, fall, winter, and then the transition to spring. Notice how that it feels like that painful selling of the fall and the winter is over. And then he really likes it when it does this little spring, winter, spring. He kind of really likes that. And now as this is approaching back into the summer, you notice that we have this kind of double bottom and the beginnings of an upward pulse. And so he's ready to enter this thing long right here, because it's had all of this time to fail and it didn't. And we've got evidence of improvements. And then our targets would be up in here. This RL270 is right there as a target. The top of the dragon is a target. The top of the RL10 is a target. So all of those are well within reason. Around 30 is that price. And so he's getting this around 22 and a half, 22.5. So that would give you plus $7. And then if you use this as your stop, you're probably talking about $1 to $2 of risk, which gives you something like a 3 or 4 to 1 reward to risk. And so U.S. Steel is looking pretty attractive in that on that basis. So nice one for U.S. Steel. Here is one on K-Web. And you'll notice that it has Bob's standard pattern. Again, we spend all our time doing bottom fishing and cat fishing, I suppose. So those are all the transitional states. This is when the winter ends and the spring has begun. And now notice it's gotten back into his little Bollinger Band River down here. And we have that little gap ready to go to where it's going to become summer. And we've already got a 1, 2, 3 entry. Bingo. So that's going to feel pretty good. So that's getting an entry around, call that 53. And if you use the PSAR dot as the stop, that's around 46. Let's see, so that's probably maybe a $5 risk. And you can see that's at about 70, and there's 80, and there's 90, and there's 100. And that's all within play on this stack to the upside. So you got a nice set of moves available to the upside in China internet, getting smashed because of China's problems in the world market. But that's evidence of failure to fail further. It didn't. And that's what all of this is telling you, the slow, stealthy improvements. So KWeb as a swing pattern. We were doing little bits of deep analysis on the holdings of some individual fund managers and positions that we're interested in studying to reverse engineer. Here's one where a guy is making a pretty strong bet on triple Russell, a full 15% of his portfolio. So here's a guy that's doing, some tactical trading, and what he's got is 65% long. So 65% is in basically SPY. Vanguard small cap ETF is 20%, but then he's got 15% in a triple leveraged Russell. So this looks like his core positions, and now he's using this as his trading position. And so that's really 3 times. So that really means that's a 45%. So he's really got a 50-50 split between US large cap and US small caps. And he's using this as the trading package, that when he's done with that, because the small caps have been lagging. So he thinks the US market's going to go up, and he thinks that the small caps, which have been underperforming, are going to return with an accelerated rate. So he's taking a larger position while keeping his core position locked in. So tactical trading technique. That's like a core and turbo in practice. So that's not magical or mysterious. It's just the way he's getting it done. All right, let's get into the specifics. Here's another one. Here's another view of U.S. steel. All right, so U.S. steel has been holding steadily here, right along that about $21. And you notice the weekly has been slightly improving and closed near the top of that. And so we saw on Bob's that it's all the way up to probably 28 is the potential. And here's one that has about a 75-cent risk, or a 60-cent risk, I should say. And I like this one because of the on the tactical trade here. And this has already broken above all of that. So getting the next little piece of momentum. And then if we can get through here, adding a second position, and then there's not much resistance in here. That was just sell off. So once it gets above here, that should really go. I like that. I like that move in US steel. That's strong. 25 is certainly, that's the first place you start seeing any of this resistance hit. So that move from here to here, from 23 to 25. I mean, that's a 10% move, you know. So you can't be afraid of that one. All right, next one up is Brazil. Brazil had been working pretty nicely. All of these little, the SSCs, the COTA 2s, everything was working. Then you get the P1. And then here's the collapsing dragon. Oh, sadness. That's why these little exits on the, when it crosses back over the dragon, protects you against those moves. And now the question is, with this little sell-off here, is this going to try to recover? Or does it look more like a return to here and here and here? Which way is that going to break? And so this gives us, here was a little recovery on the daily. So you can see how that could work just to get back to 32.5. And then if it clears that, you could think about a second position once it's cleared, like the Bollinger Band main, and you're thinking to the far side of the Z +1, Z2, and 3, and you don't really run into resistance till you hit that. So that's a pretty good move that's available from 30 to 36, which is a 20% move. And this was a pretty nice recovery. And I don't mind, I wouldn't mind getting long there. This trade frame is showing getting long from the breakout above the high, which is fine. And then I like that as a risk. I also like that as a failure, a collapsing dragon kind of a play right there. So that looks good. I wouldn't worry about second positions, just learn to track that correctly. I would wait on the second position till it gets above 32, because you want it to clear all of that resistance for sure. And that allows you to concentrate on one position and managing it correctly. Because if you get the second position on anywhere in here and you're close to resistance and it starts to fail, then you're losing at twice the rate at which you were gaining. So you don't want that to happen. You'd like that to be all just on one position right there. Let it get above 32. And then if it gets above 33.50, you could think about a third position once it's cleared that range. Okay. Natural gas. This has made a nice little recovery. 1, 2, 3 entry right there. It's got to get above 16. Oh, not natural gas. I'm sorry. This is DAX. What did I say? Yeah, DAX. Consolidation and a nice breakout. Yeah, I like that as a breakout above the dragon. Second position here, third position there. It feels good. I might cut that short right there instead of waiting for that. This is okay as a position sizing risk, but this to me would be the execution risk. So if I got long here and then it immediately rolled over, I wouldn't let it get any lower than that level. I would not wait for all of that. And I think I could be short there. I might also want to be short there with a second position here. All right, here's natural gas, the big sell-off and a bit of a recovery. The big run up to 22, sell off to 1750, and now 3 or 4 days in a row. Couldn't quite, it rolled over, but then recovered nicely. This feels like strong support. I like that breakout, aiming for 20 and then 20.5 with about a 50-cent risk. So that's about 18.50 as your entry. with about a 50-cent risk, and you're trying to get to 20.50. So that's $2 on the upside divided by 50-cent risk gives you a 4-to-1. That feels good. I love this as the breakdown. And then second position short here, because it will have broken below. And then you can see when this thing collapses how harsh those sell-offs are. So if this starts to fail, bam, that's where you want to be short there for sure. Good trade. Next up, Verizon. This one has been suffering, excuse me, compared to the rest of the Dow. You had the first SSC, which was nice after the harsh winter. The pullback found a 50% recovery at support level. So strong support at 142, and it moved $4 to 146, then sold and held slightly higher, and is trying on a 1-2. So this is like a 1-2-3 entry right there. There's your COTA 2. That's really going to be dicey until it gets above 146. But you're trying to gain $2 on about $1 risk. Yeah. If this breaks loose, that thing can really go. It has to get through 147. I think I would wait for 147 to get my second position. I'd really like to see it get above that, because if it does, now that's a gap, so it should run through there pretty fast. And then this is the next resistance level, 149. And this one is a clear short, because now you have a double high, a lower high, and if that rolls over, that's where you want to be short with a second position right there at 142.30. Verizon already hit. Next up is SQs, and this is the leveraged short. So this one is a bet on the short side, and you can see when the tech begins to fail, there's your SSC. That can have amazing moves. I mean, that's a 15% move. That almost acts like a COTA 2 on the breakout. So long there with a target here. That's a pure tactical entry. I would not be swing trading that one. If this fails, then what that's telling you is that you want TQQQ, the triple on the other side. So that's a pair trade for you to look at. Goldman Sachs. So we spent some time on Friday night, Saturday, talking about finance as a strong sector, support, and going. There's your support. Here's another higher support at 410. So about a $4 risk. It has to get above that strong resistance up in here. So that's a little dicey. So that's a bet on strength and finance. I might just be right here for execution and then trade that on the short side. I think I want to be here with maybe a $2 risk instead of a full 4. Like if this starts failing, I want out of this thing, because then you're going to get that move down to here. So I don't want to stick around any longer than this, but I like it on the upside. And just compare that one to FAS, which is the 3X of the finance sector. And you may find that to be better than Goldman. Mark. I mean, this is a wild short-term trader, so I wouldn't have any long-term beliefs in it, but there's your COTA 2 on the daily. You can see it. This looks like Mr. Toad's wild ride from 71 to 84, down to 77, back to 81. That's a wild ride. So he's playing that just with a nice tight 50-cent risk, and your upside target is 83. So that's about 3-1 on the upside. Add your second position above that price level. You're in good shape. Yeah, that's easy. This resistance is probably already baked into the cake here, and you get real resistance up here around 84. That's a good short too. Ready to play it in either direction. Last IYR. This is a real belief in the power of real estate to protect against volatility in the equities. Real strong support over here. Stupid pen, come on. Real strong support at 105. There's your little COTA 2 entry on the weekly was right here at 107, which was back in here. And there was your SSC. There is your second position as it gets above the hump, this little intermediate hump right here. And now it's testing that one. So you're getting the emerging dragon breakout. This whole area in here, you know, if I'm going to draw that as a triangle, let me clear all this. So this peak of the dragon to the belly of the dragon to this price level up here, this whole area in here we think of as the pocket. And any trade to get long inside here, whether it's an SSC or this is right here is where you see the the dragon is sloping up in the RL. This is where your owl entry is right here. This is where your SSC entry is right there. This is where crossing the Bollinger Band mean, where it's leaving the river. This is the emerging dragon way up in here. So all of these entries at these various price points, these are all being what we call in the pocket before it makes its official breakout above the previous resistance levels. And there's two of them that we look at. We look at the peak of the dragon, which always happens first, and then the peak of the RL10 as kind of the ultimate final one. In the same way you would see that pocket over in here. You'll learn to see that triangle and see that as the base. So here, 1, 2, and then the return to 3 is what you're expecting to see. Here's one that did that already. Okay. So that's a good looking trade, both directions. You can see if it breaks out, gets above here, then that thing's going to go. And then the breakdown gives you, just like those two moves, great big collapsing failures. But to me, the price of real estate is just being rewarded, and I think that feels pretty good. All right, so that's everything we got for today. We'll get this published and posted. Thanks for your kind attention, guys, and we shall see you tomorrow.